Alright guys, so we are looking at chapter 10 in your workbook. Chapter 10 is all about creating reports. So there's no new transactions this week, so literally what you submit is going to be the same that you submitted for week 9, or chapter 9 I should say, which really shouldn't be the way that it is, but it is. That's the way the course is set up. So what I want to do is I want to take a look at some of the reports in QuickBooks and navigate them a little bit. So if we look at case 1 on chapter 10, it tells us to create, print, and export to Excel a profit and loss report for January of 2018, and to customize the report by adding a percent of income column and saving it by sharing your customizations as profit and loss January 2018. So if we're going to look at our profit and losses, we're going to go to reports, and then within reports, these are my custom reports. I want to go to my standard reporting, and I have all of these reports I can look at. Now I can do a search by typing it up here for the report name, or I can go down here and look at these. And so because this week's all about just learning about reports, I'm not going to necessarily stick to the cases and whatnot. I'm just going to go through some of these reports and we're going to talk about them. So the profit and loss is up here under my favorites, and it's not one that I don't think that I saved. I think I just put a star beside of it because it's one of the most important ones that you're going to use in the real world. It's under business overview, and you have profit and loss by month, you have profit and loss, you have profit and loss detail, you have the comparison. I mean, there's a ton of these. So let's just look at the regular profit and loss, and we'll take it from there. So this is showing me from January until October 26, which is this current year. So I want to select a period. Let's compare the period. I don't want to do year to date. I want to do this year, and it's going to do all of 2018. Starting 1/1/2018 to 12/31/2018. Now the problem with this is that we started this year for the case on 12/31/17. So I'm going to go 12/31/17 to 12/30 of 18. So this is the year for us for case 1. And I'm going to run this report, and it's showing me January to December, even though I didn't change it. Let me go back to custom 12/31/17 to 12/30/18. Now run report again. Alright, so now I got my dates right. So these are the dates for case 1. I have my income here, I have my expenses, and I have my other expenses like depreciation, and I have my net income. So what this is telling me, during this year, I've lost $3,205.71. This is based on the fact that I had $17,000 roughly in sales, and these are sales of products. I have $8,600 in services, and then my cost of goods sold were $10,400. So that means the cost of these items that I sold was $10,400. So my gross profit is $15,450. Now out of this, I had expenses. The expenses that I had were things like interest expense, payroll expense, rent or lease, travel, repairs and maintenance, supplies, and utilities. So my total expenses is $18,000. So by looking at these two numbers, you know, my expenses outweigh my profit or my revenue. So I'm going to have an operating loss of $2,600. Now, in addition to these operating expenses, I also had depreciation. Now, something that we know from accounting is depreciation is a non-cash expense, which means is that we write it off on our income statement or our profit and loss, but we don't actually lose money for it. So once you take that $575 out, our net income is negative $3,205. So our net income that we're going to report on our taxes is negative $3,200 roughly. Now the difference between net income and cash flow is those non-cash expenses. So the cash flow for the period is going to be this, negative $2,600. Whereas our negative income is going to be $3,200 because this $575 of depreciation expense is a non-cash expense. We didn't pay this out. So the actual money that we took in is $575 more than what we're going to report to the IRS. I hope that makes sense to you guys. It should, if you guys remember some more from your accounting class. So this is the profit and loss. We can customize this report by doing the cash basis versus accrual basis. We can divide it by 1,000. Generally, you only want to do this if you have really large numbers. You can get rid of the cents. Most of your financial statements for publicly traded companies do not have the cents with them. You don't want to include zero amounts. Negative numbers are shown as a negative here. You can do it under parentheses and in red. Those are always a good way to do it. We can filter the rows for totals only, or we could look at active rows only. So this would be things that had content in it. So for us, it was only January. So it's going to look the same either way we do it. We could do a year-to-date, previous year if we have previous year data, percent of a row, percent of income, percent of column, percent of expense. So if we do percent of income and click run on the bottom, so you'll see right here to the right, we have a percentage for our income. So 66% of our income came from sales, 34% came from services. Now of that, we know our expenses were 70% of our total sales, right? We know that our cost of goods sold was 40% of our total sales. So whenever we talk about doing budgeting, there's several ways that we can create a budget. We can create it using a percentage of another number, right? Like a percentage of sales, a percentage of cost, percentage of revenue, percentage of profit. Or we could use a flat amount if it's a contract amount, or we can use historical numbers if we know what they were the previous year. But for a lot of things that's based on volume, or that's a variable expense, is based on cost of sales or percentage of sales, percentage of income in this case. So if we were looking at our payroll expense, this might be a percentage of sales when budgeting, because as we sell more product, we're going to need more people to sell it. So if this is 46% for January, when we budget February, we'll look at 46% as that for that number as well, based on what we're going to do for revenue. So when you create a budget, one of the first things you do is you forecast your revenue first. Once you forecast your revenue, then you can forecast your expenses. And you do this because a lot of your expenses are based on the volume of revenue you're going to do. All right, so this is the profit and loss. You can look at totals only. You can look at months. Run this report. It should show me each of the months. Yeah, so it's only showing me January as far as our income and stuff goes. And the percentages there. It shows you all the way through to the end of the year for your total. So, I mean, if we have more transactions than all these, we would see very detailed how it went up and down throughout the year. You're looking for trends and patterns, because you'll use this profit and loss for this year to do your budgeting and stuff for next year. And you look at trends, you know, where you're really heavy in sales in a couple of months, and because if it happened this year, then most likely it's going to happen next year, unless you have a one-off event that created, you know, a really high demand for April. And if you had a one-off event that created really high demand in April, then what you do is what's called scrubbing your numbers, which means you know you're not going to have that event the next April, so you take that extra income for that month out whenever you do the budget. Likewise, if you have a big expense for, you know, you bought new equipment, and you only buy new equipment every 3 years, and you bought it in May of 2018, and you had a large amount of expenses this May of 2018, when you get to May of 2019 for your budget, you wouldn't budget the same level of expenses. You would scrub those extraordinary numbers out, or those extraordinary expenses out of that number before you would forecast that budget. But this is your profit and loss in general. You can change things over here. You can go to customize and change them over here. You can get rid of the percent of income. You can look at percent of expenses. Now, it depends on what you want to look at. If you just want to look at expenses and you're budgeting expenses, you might want to look at percent of expenses and say, okay, well, this is where all of our expenses are going. So 65% of our expense comes from payroll. I mean, that's something really good to know. You have 10% going to travel, only 1% going to utilities. 1% utility expense is amazing. Doesn't matter what industry you're in. If you only have a 1% interest or 1% expense in utilities, that's good. So it depends on what you're trying to measure. What you're trying to look at is how you're going to customize this report. To save the customization, literally once you have how you like it, you're going to click Save Customization, and it's going to ask you to name it. You're going to name it. You're going to put it in a certain report group, and then you're going to hit Save. I changed this up. I don't like how it is. I wouldn't look at this on a regular basis like this, so I'm not going to save this one. But if I did want to, I would just name the report, save, and it would save it with my other custom reports, which are right here. And these are the custom reports that I did in the beginning of the course for each of the cases, so that I didn't have to go through and click on all the numbers each time. All right, so that's the profit and loss. Let's see what other reports I want you to look at. A balance sheet. So if I go back to standard reports, where I'm at, I got balance sheet right here, and obviously it's one of the ones that's saved. Balance sheet's found in business overview, and this is showing me a balance sheet as of this date, right? So I want to change that. Balance sheets are a snapshot in time, so it doesn't matter what this first number is. It's always going to show me what it's at this number, this date right here. So if I do 12/30 of 18, say, this is the end of case 1, and I hit Run Report, my total balance is 104,864.28. Now this balance will not change if I change this date. So I'm going to change this date to 3/3 of 18, which we didn't have any transactions between 3/3 of 18 and 12/30 of 2018. There was no transactions there. I'm going to hit Run Report, and I still have the same balance down here. And that's because when you do a balance sheet, it's a snapshot in time, and it's based on this last date. It has nothing to do with this first one. You can change this first one, but it's not going to affect your numbers. Only this date right here will affect your numbers. All right, so to show you that, let's change this back to 1/1 of 18, and let's change this to 1/15 of 18. And you'll see these numbers change, because right now you're at 104,864, Run Report, 101,630. That's changed because we had transactions that happened after the 15th that affected our balance sheet. So I'm going to go back to 12/30 of 18, which is the end of case 1. I have my balance of 104,864.28, and this is my total liabilities and equity. So on a balance sheet, you have two footings, and these are called footings because they should match. They're your go-to place, and so that your eye draws you to it, they're underscored twice. So you have total assets, and you have total liabilities and owner's equity. They're underscored twice. And that's because this is the end of a calculation, which is this calculation up here, and this is the end of a calculation, which are these calculations right here. So these two numbers should always match on a balance sheet because those are the numbers that balance. Assets equals liabilities and owner's equity. So for case 1, we have our current checking account. Now there's only one checking account listed on here, even though we know we have 3 checking accounts for the entire set of QuickBooks. Now I can tell you that if you have a different checking account other than just checking account 1 showing up, that means that you have a transaction that has a wrong date on it. Just like if you have your more than one accounts receivable account, like we have 3, and you have more than one of them showing up, that means you have a wrong date, or you've selected the wrong account for a transaction. You selected account 2 instead of account 1. You selected account 3 instead of account 1 when you were doing your transactions. So, I mean, this is a great way to find mistakes. Supplies asset, notice all these, none of these say 2 to them. This one says case 1, so I knew that that was for case 1. But none of these other things say case 2. These are all notes payable, 1-1, 1-2. These are the secondary notes payable for case 1. All these indicate that these are all case 1 transactions. Now, if I go to a different date range, and I can't go to a date range, I have to go to a different ending date. And I'm going to do 12/30 of 19, which would be case 1 and case 2 combined. This works just like your trial balance does. The first number doesn't mean anything, but the last number does. Now I should have two accounts of a lot of these things because we had two checking accounts, one for checking account for case 1, one for case 2. So here's my two checking accounts, my accounts receivable. Now, did I have two accounts receivable, or did I just use the same accounts receivable? Right here, it looks like I just used the same one for everything. But as we go down, we have two supply asset accounts. This is one for case 2, this is one for case 1. And like I said, if you created two accounts, you just need to make sure that you keep them separate throughout. If you use the same one for all of them, well, then you have everything thrown in the same one. Machinery and equipment for case 2, furniture and fixtures for case 2, investments, case 1 and case 2. This is where we changed them. So we know this is for case 1 and this is for case 2. We know what the balances are. Our total assets will always equal our liabilities and owner's equity. Now, to customize this report, you can do it over here like we have been. We can look at different days, quarters, stuff like that, which I think this is funny because balance sheet is a snapshot in time. You're not going to be able to look at days, weeks, or anything like that, but I'm interested in seeing it. So I'm going to select days and see what that changes us to. Is it going to show us a balance sheet for each day, the week, for each day? It might. Very unuseful. Not useful at all, I should say. You would just change the date of the report right here. Yep, that's what it's doing. It's showing us a balance sheet for each day of the year, or each day. So, January 1st, 2018, our balance sheet total is $71,000. It changes as time goes on, right? Each transaction. So, I mean, this would be useful, I guess, if you just wanted to see how your balance sheet was affected across time. But, I mean, it's not very practical. I don't know anybody that uses this. Definitely not by day. They might use it by month if you were trying to see where a big change in your balance sheet occurred, where you have large transactions at. So, like, if you do from one year to another year, your asset balance is way high or way low. You might look at your this balance sheet by a month and see where it switched, like where it jumped. Like right here, from December 2018 to January 2019, we had a big jump. So what happened there, right? I mean, that's what we're thinking in our head. What happened there? Well, we know that this is where we started adding case 2 and all the assets for case 2. It was December 31st, 2019 or 2018. So this is where you would find any significance to the report. Case 2, we started doing some machinery and equipment versus some of the things that we did earlier, like we did furniture and fixtures earlier. So you notice this count did not change all the way through after the year changed. This one was added and this one was added. But yeah, so this is your balance sheet. I'm going to go to totals only, run that report again. This is traditionally what it looks like, snapshot in time. You look at this at the end of the month, you look at this at the end of the year, maybe at the end of the quarter, but generally no more often than that. You can divide it by 1,000. If the numbers are too large for you, you can take the cents off. We want to show, I like to show negative numbers in parentheses and in red. Let me run that report and see what it looks like. And look at these little small numbers we get to deal with now. The small numbers are better for if you're dealing with like millions. So, you know, this is, 178 million. This is 28 million. This is 2 million versus, you know, all those zeros. But if you're not dealing with a lot of zeros, like for us, we're not dealing with a lot of decimal places. So we don't necessarily need to get rid of it or divide it by 1,000. You can change the row column names. You can look at previous period, previous year, percent of a row, percent of a column. You can filter through invoices and filter and vendors and stuff like that. That's going to be less useful for a balance sheet. Header and footer, you can add the company name, report title. You can get rid of all this stuff. Just got to unselect it. So you don't want it on the header or footer. Now it's all going. Now you just have the numbers. Why would you use this? Well, if you want to compare yourself to another company, you might want to take their company's name off. So, I mean, that might be a reason that you use it. Trying to save paper might be a reason that you use it. I mean, you know what company it is if you only have one company. But just different options that you can do. I put it all back on there. So that is your balance sheet report. Let's look at a couple of other ones. Cash flow. So if I go back to your report checklist or report list, I want to look at cash flow. Statement of cash flows right here. This is for the current time period that we're in. Again, if I want to look at case 1, I'm going to change it. Now this is a range. 12/30/31 of 17 to 12/30/18. Run report. And this is the cash flow that I have for the first case. So my net income is negative 3,200. Adjustments to reconcile net income to net cash, 11,000. These are things like your accounts receivable balances, whether they're increased or decreased. Just all these accounts right here are adjustments to the reconciled net income. And then so net cash provided by operations. So by operating this business, we're negative $14,000. And our investing would be like large purchases. So the way the cash flows is set up, it's set up by 3 different groups, right? It's operating, investing, and financing activities. Once you divvy out all the transactions that happen in each one of those, you can see where your cash flow is coming from. Do you have cash coming from operations, which means showing net income or net loss? Do you have income or cash flowing to you because of investing that you've done? Or do you have cash flowing to you or out of you from financing activities? Now, I can say this. If you have a financing activity, those are all cash outflows. They're not going to be inflows. Because inflows are going to be, would more be from investing. So if you look at this, your furniture and fixtures are original costs, investing. So this is an outflow. These notes payable, financing, are inflows. And maybe I said that backwards. So think about financing as you take out a loan to get money. So you have cash coming to you. So every time that you have a financing activity, you are taking out a loan or issuing stock, and you're getting cash coming in. So it's an inflow, just like a positive net profit would show, an income. Now, when you invest, it means you're buying something to hold, to invest. You're investing in furniture, you're investing in fixtures, you're investing in machinery and equipment. Those are all cash outflows, so they're always going to be a negative number. So your investing activities will always be negative, your financing activities will always be positive. These are most likely all liabilities as well. And then your net income or your operating activities can be positive or negative. Now we know that we had negative income, so ours is going to be negative. I hope that makes sense to you. So cash flows is not the same thing as net profit. For a small business, we want to show zero profit, but we want to show positive cash flow. That means we still brought in more money than we paid out, but we're not paying a lot of money in taxes because we're showing on paper that we didn't make as much money. For a corporation, they want to limit taxes, but at the same time, they want to show really high cash flow and net profits because that's how they're graded upon. Right? I mean, to a publicly traded company, they care a lot more about their earnings per share than what they do their cash flow or their net profit. But so to customize this, we can go to days, months, quarters, yada, 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 just like we had before. Customize it up here, get rid of the decimal places, get rid of the pennies, show it in red, change the date, change the heading, add filters, stuff like that. Once we select what we want, we click Run Report. If we want to use this report every year, or we want to come back to this multiple times throughout the year, we would just save the customization, change the name to whatever is going to make sense to us, add it to a group if we have a group of the same reports, and then click Save. But this is your statement of cash flows. Very important. It's one of the least talked about ones for small businesses, but at the same time, really the most important one that you have. At least from a cash perspective. I mean, companies that are large companies dealing in millions of dollars, they look at this every day because they need to know if they're going to project a a cash need. So they'll look at this statement of cash flows, and of course they have their bills in here ahead of time, they have their budgets in here ahead of time, and based on how much cash they currently have and what they're forecasting for expenses and whatnot, they'll be able to tell if they are going to have a cash shortfall. And if they have a cash shortfall, they know that they need to do financing activities in the period previous to that so that they have income, or they have cash for those cash outflows. So this statement of cash flows is a lot more than just telling you if you brought in money at the end of the period. It tells you if you're going to have enough money for the period that you're in. We got next AR aging summary, and then the inventory valuation. That's what it talks about in your book. So let's talk about the AR aging summary real quick. So if I go back to the report list and I go to AR aging, accounts receivable aging detail, or accounts receivable aging summary. Let's click on the summary first. So the summary gives me, and this is as of a date, and it's always going to be as of a date. It's not going to be a range. I'm going to put 12, 30, 20 in here because I want a lot of them. Run report. These are all my open accounts. These are all the balances. They're all over 91 days. Tell me why they're all over 91 days. They're all over 91 days because I put the date in here as 12/31/2020. Because based on it being this date and time, these would be over 91 days. Now, if I put 12, let me put 1/30/2018. How many of these are going to show current? All of them, because this is the first month of the first case. So the first month of first case, they're all within 30 days of one another, of being issued. So they're all going to show up as current. So we pull this off often. It depends on how big of a number this is and how substantial this is to your business. If it's the minimus, meaning $18,000 on accounts receivable out of a business that produces $4 million a year, then you might do this once a month. But if this is $18,000 out of a business that only makes $50,000 a month, then this is really significant, and you're going to pull it out several times a week. And you're going to say, okay, Blondie Boards owes me $15,000, and they're current. So if this happened to go over the current period, meaning by a day, it would fall into this category here, and say it's going to go a little bit at a time because there's multiple transactions that's inside of this current balance of $15,000. But say 500 goes into this, then I want to call that company and say, hey, you have an invoice for $5,000 that's over this past due because it's been past 30 days. I need you to make a payment on this. So you use this as a collection effort to track your collection and what needs collected, what's getting ready to be collected. So this says current because some of these are pay within 40 days, some pay within 15. Whatever their terms are set up, that is the rule that QuickBooks will use. So it says current, and then it says 1 to 30. So this means 1 day to 30 days past due. So this transaction could have happened a month ago, but because their terms are net 30, it won't show up here until it's been out there for 31 days. Then it'll show up here as being 1 day past due. So when it's 60 days past due, it'll start showing up here. 60 days outstanding, it'll show up here, even though it's only 31 days past due. So I hope that makes sense. If Blondie Board's billing is 45 days, then for the first 45 days after I invoice them, it'll show up here. On the 41st or 46th day, it'll show up here as being 1 day past due. So depending on what these terms are, will determine how long it takes for them to move out of current and into the aging bands. So just because something is over here and something's over here does not mean that they had this expense in the same month. It just means that it's due. It's been longer outstanding by Blondie's Boards than it has been by Sarah Hay as a function of the terms that you agreed upon. So for example, Walmart gives you they require you to give them really good terms. Like they'll pay you in 90 days. So you hold the balance on your books for 90 days. after 90 days of holding this money on the books, it'll switch over to 1 to 30 days past due, right? So it's really been on your books for 90 days, but it's only in this first band because your terms says that it's still current until it's not. So those are where the bands really matter. Days per aging period, 30 days. So if we want to change these bands, and sometimes you do, because sometimes 90 days is too much, or you can't just afford 90 days. Sometimes 90 days isn't enough, depending on the industry you're in. You can say 15-day age bands, and I want 8 of them. Run report. Now you have these. So you know when it hits when it hits in here, you send them an email reminding them of the outstanding payment. When it hits here, you give them a phone call. When it comes here, you send them a certified letter. When it comes here, you send them a second notice certified letter. And when it hits here, you send them a collection. You send it to a collections agency. That's how you would set up your accounts receivable. You would have different age bands that would trigger different activities. So the most common are 30-day age bands. But I've seen companies do 5-day age bands or 15-day age bands. It just depends on the industry, how much you have in collections, how fast you need that money, and things like that. As you progress throughout these bands, the less likely that you'll collect that money. It's less likely that you'll collect that money. So say we collect 90% of everything that's current, but out of everything that's 1 to 15 days, we only collect 80%. And then from anything that's 60 to 30, we only collect 70%. But then after it's over 31 days, we can only collect 50%. And then when it hits this, we only collect 15%. And then by the time it hits 91 days, we collect about 2% of everything that's going to be in 91 days. So once we know about how much we collect in each band, we know based on how much our overall total is here, how much we're going to have for the allowance for doubtful accounts. Which means we have this much in AR, 18,550. But because of history and our collection efforts and our policies and procedures and everything else, we know that a certain percentage of this is going to be uncollectible, meaning we issued you credit, but you're going to default on that credit. Say for easy numbers that amount is $550. So if I know out of this 18,550 that I'm not going to collect $550, I have an account called a contra asset account. My asset is the accounts receivable. The contra asset is allowance for doubtful accounts, which means that I'm going to put $550 in allowance for doubtful accounts so that my AR balance is going to be my accounts receivable minus my allowance for doubtful accounts, which would give me $18,000. So on my books for my balance sheet, I only have really $1,800 or $18,000 in accounts receivable, a net accounts receivable, because some of that's going to be uncollectible. Now, is that important for a small business owner to do? If you're not doing if you're doing cash basis accounting, then no, it's not important to do it, because you wouldn't even be recording this as income until you receive the cash. But if you're doing accrual accounting, then you're going to want to have that allowance for doubtful accounts, because you don't want to overestimate how much cash you actually have. If you do end up collecting higher than what you expected at the end of the year, then you post adjustments to it. And that might be all too technical, and it has nothing to do with QuickBooks maybe per se, but at least you kind of understand better about AR aging summary, what it's really for, and stuff like that. Now, this is where you start off. The very first one you do is the AR aging summary, because it'll tell us, you know, what accounts have what balances, and you know what to work on. But whenever you start working in one of those accounts, you need to know what exactly was billed to that account. So you're going to go down here to accounts receivable, aging detail, and now you know, and this is the date that today's date. You know that you have this many invoices. This one is over 91 days past due. They're all over 91 days past due in this example, because we're, you know, almost at the end of the year and we didn't do any transactions. But this tells us the invoice, the date, the invoice date, the due date that it was, the amount that it was, and how much they still owe. So this is important, because if I need to resend these invoices, or I need to tell them, hey, you didn't pay invoice 1002, Sarah, Or I need to call Surfrider and say, hey, you owe us $2,500 still. You've paid all your invoices, but this one's still missing. You just come in here and you click on that, and they'll say, oh, well, I'm sorry, I must have skipped it, or I didn't put it in I don't have it in our system. Can you please send it to me? You click on it, and you can send it from here. Send later, or send now, or whatever else you need to do. Or you can take a payment maybe right over the phone with them. But this aging detail is what you would go to next once you have your your list of accounts, your summary done. Summary is important. It gives you an overall balance and see which accounts are the worst and what's over 90 days, yada yada yada. The aging detail shows you the individual invoices that are overdue. So if these were all Sarah Hay, all three of them, and only one of them were 90 days overdue, and it's this one. Well, I would only call them about this one worth $1,030 because it's the only one that's past due. The other two in here are not past due in our example. That's why you want to know the detail about it, because you're not going to call and say, hey, you owe us $80,000, and they say, yeah, but we just purchased that yesterday. We really only owe you $1,000 from last month. That's why the detail matters so much. You can change the bands again. You can change the number of periods. Customize it again by the same things. Take out the cents, divide by 1,000. Change the way negative numbers are displayed. All that kind of stuff. Save it just like the other reports. Big takeaway is that you're going to use the summary first, the detail later, and your amount in your bands of days and your number of bands are really going to be dependent on your industry and your specific business and tolerance to risk. If you can take a little bit more risk, then you have less bands, because the more bands you have, that means the more you're going to be managing it. And if you aren't managing it more but you have more bands, that means you don't need to have as many bands, because the bands are supposed to trigger something, trigger a phone call, trigger an action of some sort. And if those bands aren't triggering actions, well, then you either aren't doing the collection efforts that you need to, or you have too many collection efforts scheduled that are unnecessary. So you change the bands back to, or dial them down to match the level of activity you need to be involved in the aging detail. Alright guys, so that's the majority of the reports. The only other one's the inventory valuation summary. I guess we'll look at that real quick. Inventory valuation. I don't look at this one that often. I'm going to type it in up here. IMVNT. Inventory valuation detail. It's looking at the summary. So this just tells us on this date, this is how much we have of each, and this is the value, and then this is the average. This is the overall value, right? The average value. So the average value is the price each. There's 4 of them. 4 times 400 is 1,600. This is going to be if you have a product-driven company. If it's a service-driven company, you're not going to look at this report at all. But things you can do is customize the rows. That's about it, to get rid of non-zero rows. And then you can customize the filters and the format. And that's about it. It's not a very customizable report. You can't change a lot on it. You might have a SKU. You might not have a SKU. But you have the quantity. Generally, the way you see these set up a lot of times, though, is your quantity, your quantity, the cost, and then the book value of it. With the QuickBooks here, we have the quantity, the cost, and the book value in the middle. So this would be the book value. So I have $2,700 in assets on my account at this date and time. If I change this date to 2020, run my report, completely different. I have these quantities and I have these values. So some of these are 0. If I do non-zero and run the report, I only have things that have actual balances. That's just how you customize it. Save the customization over there on the top right, and you just rename it. Alright guys, so this is going to conclude my video for chapter 10. Like I said, in the video, in this week in general, you're going to go through case 1, case 2, case 3, and you're going to look at reports, you're going to create reports. You're really just playing around, but at the end of the day, you're going to submit the same reports that you submitted for Chapter 9, which is your trial balance and your transaction detail by account. So the big takeaway here is if you missed something last week, make sure you go back through and fix it so that your balances all match, so you don't miss it again this week. It should be a really easy week for you guys. It's just really exploring the program a little bit more. So I hope you guys take the time to do that. At the end of the day, I'm not really going to know if you have or not because you're not submitting any of those reports. So it's kind of like the honor system. If you have any questions, reach out to me. If you need help balancing your accounts, there's a couple people that I still don't have access to view their accounts, but everyone else I do. You need something, give me a call, shoot me a text message, or send me a email. All right, guys, have a good one.